Welcome to Financial Accounting 1. Financial Accounting 1 is an introduction to accounting and accounting business. This is our first instruction, so we're basically going to go over a few quick tips in Blackboard as well as in Cengage and kind of how to navigate through before we really get into chapter 1. So first things first is let's kind of pop over into Blackboard. So here is Blackboard. Before you do anything, I want you to go ahead and click on the Start Here and go through all the assignments in the Start Here module. So if you have not done that yet, please go ahead and pause this video and complete all the steps in the Start Here module. Okay, so I'm hoping that you have already completed the Start Here steps, and then let's go ahead and click into your lessons module. Your lessons module is where all of your learning modules are going to be. We have a learning module for each week of the 8-week summer semester. So we are doing a lot in 8 weeks. So every single week you will have an assignment and a discussion post due. So let's start clicking into Learning Module 1. In Learning Module 1, you'll have your learning objectives, what your assignment is, and a link to that assignment, and as well as a link to the discussion post. You will also have a folder with instructor-created learning and review resources. This is where you'll find additional PowerPoints, videos, and any handouts to help with studying and completing your assignments. So when you click on assignment 1, it's going to take you into Cengage. And here are all your assignments in Cengage. If you see here, you have assignments 1 through 8, as well as your midterm and your final exam. All of those will be done in Cengage. We will also be doing practice problems for each chapter, and I will have a separate video where we go over and do the practice problems together. Now, let's go into the ebook, which is also in Cengage. Okay, so this week we will be doing chapter 1, which is Introduction to Accounting and Business. So here are some of the learning objectives that we'll be going through in chapter 1. So we'll be discussing the natures of businesses, what types of businesses, their roles of businesses, what is generally accepted accounting principles, what is the accounting equation, what are business transactions in the accounting equation, and then we'll also discuss some financial statements. What are the financial statements, as well as financial analysis and the interpretation of financial analysis. Now, this is something we will go in depth throughout the rest of the semester. But this is just an introduction to all of those to help us kind of get familiar with some of the terms. So let's start with nature of business and accounting. Okay, what is a business? It says in the textbook, it says it's an organization in which basic resources / inputs, such as materials and labor is assembled and processed to provide goods or services, which is an output. Basically, a business is anything that can produce something and sell it, whether you're selling a good or you're selling a service. Now, regardless of the type of business it is, every business has the same goal, and that's to earn a profit. So the question is, what is profit? Profit is the difference between the amounts received from customers for the goods and services and the amounts paid for the inputs used to provide the goods or services. In other words, it's your revenue minus your expenses. That is your profit. So all the money you made less all the money it took for you to make that money. Because the term is it takes money to make money. You have to spend money to make money. Different ways of saying it, but that's what profit is. What you have left over at the end of the day. So there's 3 major types of businesses. You have service businesses, which only provide services. Then you have merchandising businesses, which provide a good that's sold And under each of these is examples of what each are. And then of course you have a manufacturing business, and the manufacturing business works really closely with the merchandising business because they're obviously manufacturing the goods in which the manufacturing business is going to sell. So what is the role of accounting in business? So the role of accounting in business is to provide information for managers to use in operating the business. That's really kind of generic, isn't it? It's a system, to be honest with you. It's an information system. And I don't mean like a computer system. Well, yes, there is accounting softwares out there. When I say an information system, it's not necessarily talking about a computer system, but it's basically a system in which information is used and created and the flow of it. That is the system I'm talking about. So in an accounting system, of course, you're going to identify who your users are, assess the user's needs, and then design the flow of the information, like how the information is put together and how the information is disseminated. And then, of course, you're going to record the information and then prepare the information for reporting to the users. That is what the accounting information system is all about. And that's the role of an accountant, is to do basically all of those things. Now, ethics. Ethics are very important in accounting. The objective of accounting is to provide relevant, timely information for user decision making. So what does that mean? Accountants have to provide accurate data so that the managers and the business owners can make the best decisions for their business. So if they're not showing a profit, then they need to be able to know how to make decisions to change that and show a profit. If you're not providing them with accurate information, then they're not able to make decisions that's most efficient for their business. And that's where ethics come into play. Ethics are moral principles that guide the conduct of individuals. Pretty simple definition. So ethically speaking, it's the accountant's ethical, moral obligation to provide the most relevant, timely, and accurate data. Unfortunately, many business managers and accountants sometimes behave unethically. And many of these managers of these companies listed here in Exhibit 2 were engaged in accounting and or business fraud. These ethical violations led to fines, firings, lawsuits, and in some cases, even prison. So I'm pretty sure you guys have pretty much heard every one of these companies. There's no doubt in my mind that you've at least heard of Enron. So the next question you want to ask yourself is like, why? What would cause managers and accountants to act unethically? Well, sometimes it could be due to, it says here, failure of individual character. So basically what that means is ethical managers and accountants are honest and fair. However, managers and accountants can be sometimes faced with pressures from supervisors to meet company and investor expectations. So the managers and accountants justify small ethical violations to avoid such pressures. However, those small violations became big violations as the company's financial problems became worse. So if they are being forced to meet certain quota, a certain percentage or a certain any kind of demand, and unfortunately, for whatever reason, that demand is not being met, that quota is not being met, that expectation is not being met, for fear of losing their job, that they fudge the numbers, which is how they justified that small ethical violation, which as we said before, managers make their decisions based on the numbers the accountants provide them. So if those accountants are fudging those numbers to make them look good, to meet those expectations, and the company owners are assuming they're meeting their expectations, and they make big, huge financial decisions, it does domino effect, correct? Now it says another reason why people make these unethical decisions is based on a culture of greed. A culture of greed is probably the main reason most of these companies up here in Exhibit 2 committed fraud. But by their behavior and attitude, the senior managers set the company culture. So if the senior management's greedy and it's all about profit and making money and lining their pockets, then they've created a culture of greed. And therefore, everyone under them is going to act in the same way, and therefore not follow guidelines, policies, procedures, and must certainly not act ethically. So as a result of the accounting and business frauds shown in Exhibit 2, Congress passed laws to monitor the behavior of accounting and businesses. An example of that is the Sarbanes-Oxley Act, which is the new oversight body for the accounting profession called the Public Company Accounting Oversight Board. In addition, SOX established standards for independence, corporate responsibility, and disclosure. And here's like some guidelines here below that they've kind of created to determine how to act ethically. Real quickly, another really famous fraud case was the Bernie Madoff case, where he was the most famous person pulling off a Ponzi scheme. So what is a Ponzi scheme? A Ponzi scheme is where like the investment manager uses funds received from new investors to pay a return to existing investors rather than basing investment returns on the funds of actual performance. Okay, so what does that mean? Okay, so let's say Bernie took $1,000 from 10 people, so now he's got $10,000. Well, he didn't invest that $10,000. He used that $10,000 to go buy himself something. Okay, well, now those 10,000 people that invested, those 10 people that invested money is expecting a return on their investment. So what does he do? He goes out and finds new investors. Okay, and he takes the money he got from the new investors to pay a return to the old original investors. And it's just a continuous cycle. So as long as the investment manager is able to attract new investors, they'll have new funds to pay existing investors and continue the fraud. Most Ponzi schemes collapse quickly when the investment manager runs out of new investors. But Bernie Madoff had a very good reputation, was very popular, and had a lot of personal contacts, which provided him a steady stream of investors and allowed him to continue the fraud over decades. All right, real quickly, I'm just going to go over this really quickly. I do encourage you to read chapter 1 in depth. I don't just use my video instruction because I'm only going to be hitting on key things. But here's different career paths and salaries for different types of accounting. There's private accounting and public accounting. In private accounting, you normally work for companies, government, and not-profit entities. In public accounting, you most likely work freelance. You most likely have your own company. Some companies do hire CPAs, maybe under a contractual basis, maybe even under a permanent basis. But the different types of jobs, career options, salary, and the certifications needed for each job are listed here. So if you are interested in a profession of accounting, this is a great little exhibit to kind of look at to try to decide what would be the best course of action for me. So now let's talk about generally accepted accounting principles. GAAP, generally accepted accounting principles. So that's a mouthful. So you will hear me refer it to as GAAP. Now, the last time I asked if anybody knew what GAAP was, they said, yes, GAAP insurance. It's that stuff you buy when you buy a new car. No. GAAP is, again, generally accepted accounting principles. So if companies did not follow the same rules on reporting financial information, comparisons among companies would be impossible. So GAAP created a set of rules when preparing your financial reports. Accounting principles and concepts developed from research, accepted accounting practices, and pronouncements of regulations. And within the United States, the Financial Accounting Standards Board, also called FASB, is the primary responsibility for developing all of those accounting principles. Okay. And then furthermore, in addition to the FASB, we have the Securities and Exchange Commission, also known as the SEC, which governs the companies that are publicly traded. Now, that's within the United States. Outside the United States, there is the International Accounting Standards Board, the IASB. There has been talk about the United States converting to the IASB, especially now that more and more companies are becoming international within themselves. And of course, with the use of the internet, it's obvious that it's more and more important that throughout the whole world, everybody be using the same accounting principles. So, business entity concept, another new term that we're learning, business entity. What is a business entity? So whether you are a sole proprietorship, a partnership, limited liability, the accountant is in charge of recording the transactions solely for the business. So, and not for the personal activities of the owners. So if the owner buys a building and that building's for personal use, it would not be recorded in the accounting transactions for the business. Only if that building that the owner purchased is going to be used for the business, would it then be recorded in the business and the accounting transactions. So that's the concept of business entity. Anything done for the business is recorded in the accounting transactions for that business. Anything that was done personally by the owner or owners for personal purposes should not be recorded under the business transactions for that business entity. And then here's examples of different types of businesses and what their characteristics are and what their examples are. I'm not going to go through reading them, but I do encourage you to read them for yourself, whether you pause this video and read them or you independently read chapter 1. All right, so the next concept is the cost concept. How do I know what to record that building that my business owner just purchased? So your business owner just purchased a building and you have to record that transaction in the accounting transactions for the business. How do you know? So because he hands you this information, and what he does is he hands you a piece of paper with all these numbers on it. You have the price that was listed at, you have what Aaron Publishers initial offer to buy was for, then you have the purchase price, then you have the estimated selling price, and then you have the tax assessment value of the property. Which one do you use? Simple. Under the cost concept, Aaron Publishers records the purchase of the building on February 20th, 2017 at the purchase price of $150,000. The other amounts listed have no effect on the accounting records. So let's look down here at example exercise. So it says here on August 25th, Gallatin Repair Services extended an offer of $400,000 for land that was listed for sale for $500,000. On September 3rd, Gallatin Repair Services accepted the seller's counteroffer of $460,000. On October 20th, the land was assessed at a value of $300,000. And on December 4th, a national retail chain offered Gallatin Repair Services $525,000 for the land. What value should the land be recorded in the Gallatin Repair Services record? Again, you only record the purchase price. So here, on September 3rd, Gallatin Repair Services accepted the seller's counteroffer of $460,000. So that should be the amount you record. All right, now this is huge. This is very important. I'm going to spend a little more time on this one. This is the accounting equation. The accounting equation. You will use this throughout the rest of your accounting professional career. Before we can discuss what the accounting equation is, let's discuss what these terms really mean. So first, let's start with assets. What are assets? These are the resources that your business owns. Examples, cash, land, building, equipment. Resources that your company owns. All right, so the rights or claims to these assets are then divided into two types, the rights of creditors and the rights of owners. All right, and that's where your liability and your owner equity comes into play. So the rights of creditors are the debts of the business called a liability. So let's say you borrowed money to buy that building, then the money you borrowed to buy that building is then a liability. So that becomes the right of creditors. All right, now the rights of owners of a proprietorship, partnership, or limited liability company is called owner's equity. So all of your assets, less your liabilities, becomes your owner's rights of owners, your owner's equity. And then of course, if it's a stock, if it's a corporation, then it's the owner's equity is called stockholders' equity. So with all that explained, again, your assets are all of the resources you own for your business. Your liabilities are debt, money that you owe, creditors. And then your equity is basically what's left over. So your assets less your liability equals your equity. But that's not your accounting equation. So I want you to look really quickly right here. This right here. This is your accounting equation. All right. Your assets, which equals your liabilities plus your owner's equity. Okay. This equation is called your accounting equation. Liabilities are always going to be shown before owner's equity in the accounting equation because creditors have first rights to the assets. And again, assets are divided into two categories: the rights of creditors, which is your liabilities, all right, and then your rights of owners, which is your owner equity. Okay. Now, given any two amounts, the accounting equation can be solved, okay, for the third unknown amount. So this is like if, A plus B equals C. If A and B are known and not C, then you can manipulate the equation to be able to solve it. And here's an example. So you know what your assets and your liabilities are, but you don't know what your owner equity is. Well, that's simple. If your assets equals your liabilities plus your owner's equity, then owner's equity equals assets less your liabilities. Now, let's look at an example of an accounting equation. It says here that John is the owner and operator of Eurostar, which is a motivational consulting business. At the end of its accounting period on December 31st, 2018, Eurostar has assets of $800,000 and liabilities of $350,000. Using the accounting equation, determine the amounts, following amounts. So it says, first of all, what is the owner's equity as of December 31st? So if we know A and B, we can find C. So if assets equals liabilities plus equity, then equity should equal your assets less your liability. So if we take our assets of $800,000 minus our liabilities of $350,000, then our owner's equity should be $450,000. Now it says if owner's equity as of December 31st, 2019, assuming the assets increased 130 and the liabilities decreased by 25,000, What is your owner's equity? Again, so you see here that the equation is the same, and it's just a matter of just applying simple math concepts to get your answer. So if if your liability decreased by 25,000 and your assets increased by 130,000, then basically your new owner's equity should have increased by 155,000. So if you take that 155,000 plus the 450,000 from the previous year, your new owner's equity should be of a value of $605,000. Now, let's talk about business transactions and the accounting equation and how do they all play together. Well, what is a business transaction? Paying a monthly bill, such as a telephone bill, affects a business's financial condition because it now has less cash on hand. Such an economic event or condition that directly changes an entity's financial condition or its results of operations is a business transaction. So in other words, every time you pay a bill, you reduce your cash. That's a business transaction. Every time you sell a good or service and you increase your cash, that's a business transaction. Another example, purchasing land for $50,000 is a business transaction. In contrast, a change in a business credit rating does not affect cash or any other asset, liability, or owner equity amount. All business transactions can be stated in terms of changes in the elements of the accounting equation. So if you are increasing cash, you're increasing assets. If you increase assets, you have to either increase liability or increase equity, because again, assets have to equal liabilities plus equity. So if you increase one side of the equation, you have to increase the other. So in simple terms, a business transaction is any transaction that changes your accounting equation, whether it's increasing one side, decreasing the other side, vice versa. So a great example, again, we talked about assume, which is purchase of land. But here, let's talk about another example of Chris Clark. Chris Clark begins a business known as Net Solutions. And we're going to be using Net Solutions as an example for the first 4 chapters. So the first phase of Chris's business plan is to operate Net Solutions as a service business, assisting individuals and small businesses in developing web pages and installing computer software. So Chris expects this initial phase of the business to last 1 to 2 years. During this period, Chris plans on gathering information on the software and hardware needs of customers. During the second phase of the business plan, Chris plans to expand Net Solutions into a personalized retailer of software and hardware for individual and small businesses. But in the first 4 chapters, we're going to discuss Net Solutions as a service business only. So each transaction during Net Solutions' first month of operations will be described in the following paragraphs, and the effect of each transaction on the accounting equation is then shown. So let's do an example. So on November 1st, 2018, Chris Clark deposited $25,000 into a bank account in the name of Net Solutions. So he immediately increased his cash. He did in what they call an investment, where he invested $25,000 into his company. So now he's got $25,000 in cash, which is assets. And that with no liabilities, all $25,000 of that is owner's equity. That is his equity because he has no liabilities at this point. So his accounting equation is basically assets equals liabilities plus owner's equity. There's 0 liabilities. So his assets basically equals his equity. Now let's look at the next transaction. Net Solutions pays $20,000 for the purchase of land as a future building site. Okay, so now let's look at how this affects the accounting equation. All right, so he's going to take $25,000 and purchase land. Both cash and land are assets. So if you look at the accounting equation, he's basically just transferring $20,000 from one asset to another, but it is not changing his owner's equity at all because his assets still equal $25,000. Now let's get a little more complicated. Net Solutions now is going to purchase supplies for $1,350 and agrees to pay the supplier in the near future, which means he's not paying cash for his supplies. He's paying it with credit. So now he's creating debt. So let's go down here. The liability created by a purchase on account is called accounts payable. Items such as supplies that will be used in the business in the near future are called prepaid expenses, which are assets. All right. So the effect of the transaction is to increase assets and liabilities. So if you look here, he purchased supplies, okay, which is an asset, and he purchased it on account, which is a liability. So now he has increased his assets by $1,350, but he did not increase owner's equity. He increased liability. But if you take that 1,350 plus the owner equity of 25,000, it equals 26,350, which does equal his assets. So here we have a complete accounting equation where assets equals liabilities plus owner equity. That's how assets, liabilities, and equity are created in the accounting equation when a business is begun. Now, you may have earned money by painting houses or mowing lawns. If so, you received money for rendering services to a customer. Likewise, a business earns money by selling goods or services to its customers. This money they earn is called revenue. During its first month of operations, Net Solutions received $7,500 for providing services to customers, and the receipt of cash increases Net Solutions assets and also increases Chris Clark's equity in the business. The revenue of $7,500 are recorded in a fees earned column to the right of Chris's capital. So let's look here. We have a beginning balance of cash of $5,000. We just increased it by $7,500 from the revenue that Net Solutions generated. Okay, so we've now increased our assets to $33,850, but we have to balance our equation. So on the other side, where does that money go? Over here, fees earned. Revenue increases owner's equity. So anytime you increase your revenue, you are going to be increasing your owner's equity. And since it's for services rendered, we call it fees earned. So by increasing the owner's equity, we've now balanced the accounting equation. So one more, transaction E. Net Solution paid the following expenses during the month: wages, rent, utilities, and then some miscellaneous expenses. What are expenses? Assets used in the process of earning revenue are called expenses. Expenses include supplies used, payments for employee wages, utilities, rent, etc. So Net Solutions paid the following. They paid $2,125 in wages, $800 in rent, $450 in utilities, and then they had a few miscellaneous expenses that added up to $275. So how does this affect the accounting equation? Well, real quick, we talked about revenue. Okay, revenue earned increases owner's equity because that's money coming in. Expenses are the opposite. Expenses is money going out. It's your outflow of cash. So all these expenses add up to $3,650. So we have now decreased our cash because it's cash out. It's outflow of cash because we have to use cash to pay our expenses. So we've decreased our assets by $3,650, but we have to balance that equation. It's not a liability. We did not create debt with this. We are paying expenses. So it actually just like how revenue increases owner's equity, expenses do the opposite. They decrease owner's equity. So we've had to come over here and decrease our owner's equity by that, all the amounts of those different expenses, thus balancing our accounting equation. Now, let's do one last transaction. Oh, we have a couple more transactions. Okay, we have 2 more transactions. So let's talk about this. All right, now, do you remember when we bought supplies and we bought it on account? Well, we had to pay that money back. So here's an example of where Net Solutions paid their creditors on account $950. So again, we have to balance that accounting equation. So the first thing we're going to do is, okay, we're paying money outflow of cash. So we're going to reduce our cash balance by $950, which reduces our assets down to $29,250. So what else are we going to reduce on the other side of our equation so that it balances? Our liabilities. We're reducing that debt because we're paying a portion of it off. We're paying $950 off. So we're going to come over here and reduce our accounts payable by $950. And when we do that, we reduce our liabilities and our accounting equation is now balanced. So here's another transaction. Chris Clark determined that the cost of supplies on hand at the end of the month was $550. Okay, so now what's happened is we've used some supplies. That's fine. We're supposed to use supplies. So at the end of the month, you're going to do an adjustment to your supplies. What's going to happen here is the supplies that you purchased, you have to now expense because you've used it. And that's how accounting works. So when you buy supplies, you record it as an asset. As you use those supplies up, you reduce the asset and record it as an expense because they now can be expensed out because they've been used. So what we do here is we actually reduce our supplies by $800 because the difference between $1,350 and $550 is $800. So we know what we have on hand is worth $550. What we had initially was $1,350. So the difference is $800. So we know we got to reduce it by $800 to get it to be able to the amount we have on hand, which is $550. And then we're going to come over here at owner's equity and we're going to record a supply expense of $800. Thus now, again, balancing our accounting equation. And the last transaction, Chris Clark withdrew $2,000 from Net Solutions for personal use. So he just paid himself, basically, is what he's doing. He's withdrawing money out of his company to kind of pay himself. He needs a salary too. So that's basically what he's doing. He's the sole proprietor, so he's going to pay himself a salary. And so he's going to pull out $2,000. So obviously he's taking out cash. So what we're going to do is we're going to reduce cash. But we're also going to come over here and create another account called the drawing account, which directly reduces capital. And when that happens, we now have balanced our accounting equation because we've reduced our equity again by $2,000 and we reduced our cash by $2,000. So both sides of the equation got reduced by $2,000, keeping the equation balanced. That is business transactions in relation to the accounting equation. It's all understanding the relationship between assets, liabilities, and owner's equity, and how each business transaction affects each side of that equation. So let's now talk about financial statements. There are 4 different types of financial statements, and each of them records a very unique set of information that is very, very valuable to business managers and owners. So let's start with the income statement. The income statement is a summary of your revenue and expenses. You remember those are new terms we just learned. Revenue is what we call money that you bring in from the sale of your services or your goods. And expenses is the money you pay out to run your business, your wages, your utilities, your rent, etc. So your income statement is going to take a total, is going to list all of your incomes all the revenue that you've earned. And then it's going to subtract out all the expenses you had to pay out to run your business. And hopefully what's left over is that word we learned, profit. So this is an example right here a very simple income statement. Here's your fees earned. So if you remember in Net Solutions, we earned $7,500 in revenue. And then here's all of our expenses that we paid out throughout the whole month, which totaled 4,450. So to get our net income or our net profit, we're going to take our total revenue, subtract our total expenses, and that gives us our net income for the first month of November. Now that brings us to our next financial statement. Now, if you look up here, you notice they're in order. Okay, this is the order that they must always be prepared in. You cannot prepare them out of this order, and y'all, I'm about to show you why. Okay, so now we just did our income statement where we took our revenue and subtracted out our expenses to get our net income. Next thing we're going to prepare is called our statement of owner equity. And that is a summary of changes in the owner's equity that have occurred during a specific time. And this specific time is November. Okay, so if we look over here, this is our statement of owner equity. In the statement of owner equity, it's going to have what our previous capital balance was prior to November 1st. Well, there was nothing because we didn't start the business till November 1st. Okay, so that'll be a 0. Now, if you had, that would be a carryover, but it doesn't. Next thing is any investments. Well, yes, we had our initial investment on November 1st of $25,000. And that's when Chris Clark deposited $25,000 into the bank account for Net Solutions. And now here is where I tell you it has to be done in a specific order. You're going to now take the net income from your income statement and record it on your statement of owner equity because your net income increases your equity. And you're going to list any withdrawals. So if you remember, Chris Clark withdrew $2,000 for personal use. So we have to show where he did withdraw $2,000. So our new owner's equity balance is $26,050. Now, that takes us to our third, that takes us to our third financial statement. Our third financial statement is a balance sheet. And a balance sheet is a list of your assets, liabilities, and owner's equity at a specific date. And again, your balance sheet is going to follow your accounting equation. So on your balance sheet, your total assets should equal your total liabilities plus your owner equity. So let's look down here at Net Solutions balance sheet. We have here our assets. So we have a cash balance of $5,900, supply balance of $550, and land that we purchased for $20,000. So our total assets should equal $26,450. And if we look over here, we have our liabilities, which is $400. That is the amount that we still have on our books that we owe for purchasing supplies on account. And if you look up here, the owner's equity in the equation is brought down directly from that statement of owner equity that we just balanced. So if we add up our liabilities plus that owner's equity amount, it should equal our assets. And our last financial statement is our statement of cash flows, which is basically what that is. It's just a statement of cash flow. It's all about your cash. It's all about that cash balance right there. Okay, so statement of cash flow is a very unique financial statement, and that it shows all of your cash inflow and outflow for specific activities, operating activities, investing activities, and financing activities. So it tells us where did our money come from and where did our money go, specifically our cash. Where did our cash come from? Where did our cash go? So here it shows we received $7,500 cash from operating activities because that was our revenue. And it shows that we spent $4,600 for payments for expenses for running our operation. And so our net cash flow from operating activities was $2,900. And then it shows here that we had an outflow of cash for investing because we purchased land for $20,000. Okay, and then financing activities. Well, we do know that Chris initially invested $25,000 of owners investing, but he also withdrew $2,000. So we have $2,900 net cash flow from operating. We had a negative outflow of cash for investing when we purchased land. And then we have a net cash flow of finance activities of 23,000, which then if we took the difference of all three and add them up, our cash balance equals 5,900, which ties back to our balance sheet. Now, I'm going to allow you guys to finish reading the chapter yourselves regarding income statements, as well as your statement of owner equity. I encourage you guys to do the example exercises for each of them. As you see here, it goes through each statement and shows you how to do it. I will be posting videos every week going over the chapter that we will be reading. And I will also be posting separate videos where we will be doing practice exercises that are very similar to those in your homework. So again, if you have any questions, please feel free to email me. I usually respond to emails within 24 hours. Sometimes on the weekend, it may take me up to 48 hours to respond. But I hope you enjoyed accounting. I hope you continue taking accounting, and I hope you consider making accounting in a career. So until next week, enjoy.